Up next, we have Pedro Palandrani, research analyst with Global X. He's going to discuss thematic investing with us and how to leverage some of the exciting category trends when selecting ETFs for your portfolio. Welcome, Pedro. Before I pass the mic to you, I just want to remind the viewers that Pedro is going to take your questions at the end of his presentation, so be sure to type in the box on the right-hand side of the screen any questions that you have for him about the topic that he's going to discuss. Take it away, Pedro.
Thanks, Lindsay, and hello, everyone, and thank you for taking the time to join today's presentation. I'll be discussing what's the next big theme in thematic investing. Again, my name is Pedro Palandrani. I'm a research analyst here at Global X ETFs, and I cover our suite of thematic ETFs. Before we get into the meat of this presentation, just want to talk a bit about Global X ETFs. We were founded in 2008, and we have been recognized as a leader in developing intelligent and undiscovered investment solutions for our clients. We're an ETF issuer based out of Manhattan with over 70 ETFs and over 12 billion in assets under management as of 12/31/19. Many investors, and some of you may know Global X for our income suite, which includes our super dividend family of ETFs, our covered call suite, as well as our MLP ETFs. But we're also known for a rapidly growing thematic ETF suite, which consists of 18 thematic ETFs. We're going to be discussing 3 of those here today. But hopefully we get some questions at the end about other funds that we also cover. What we will be discussing today is thematic investing, and I want to start off by discussing 2 different investment approaches. You know, many portfolio managers are faced with the tension between building a portfolio based on what they have learned from the past and their expectations for the future. And we have seen many strategies based on the premise that historical stock patterns repeat themselves. Basically, the idea is to outperform a broad market index with these historical patterns. This is basically taking into account mean reversion, as you can see on this slide. But thematic investing takes a different approach. It's forward-looking in nature, and it's based on the premise that future themes will have little resemblance to the past. Today, here's the table of contents. I'm going to be touching on thematic investing, a couple other interesting points, but then we'll dive into 3 super interesting themes. One is Internet of Things, the other one is video games and esports. Then we'll be looking at lithium and battery technology, and then we'll find out how to use thematic investing in a portfolio. And again, at the very end, we'll have some Q&A, so hopefully we get some questions. Starting at a very high level, we define thematic investing as the process of identifying disruptive macro level trends and the underlying investments that stand to benefit from the materialization of those trends. This basically requires a 2-step process. First, we identify the themes that we have a lot conviction in. We look at total addressable market, revenue growth, penetration level, and many other factors to really get an idea of the potential of the theme. And then we look for the companies that we believe stand to benefit from those macro level trends. So by nature, thematic investing tends to be growth focused and unconstrained by any geographic or sector definitions. And although thematic investing is not new, it has been growing substantially within the ETF space over the last few years. As you can see here, at the end of Q4 2019, there were about 121 thematic ETFs and about 28 billion in assets under management in aggregate. So with this growth in mind, we have found an increasing need to organize and make sense of the thematic investing space. We recently introduced a thorough classification system for disruptive themes and the thematic ETFs that track these ETFs. This thematic classification system, as you can see, consists of 4 layers. You have categories, mega themes, themes, and sub-themes, with each layer becoming sequentially narrower in its focus. This may be especially helpful for investors to understand the thematic landscape and how can the opportunities be exposed in the thematic space. And then we're often asked, how do we choose the themes we launch in an ETF? And it really comes down to a 3-part test. First, we must have high conviction in the theme playing out the way we expect it to. So again, we look at that total addressable market, revenue growth rate, and we really want to have a high conviction in that theme playing out in the future. Then number 2, we look at investability, meaning that a basket of stocks must exist with exposure to the theme, right? Sometimes this may be the deal breaker because there may be some super interesting themes out there, but there are not enough public available securities to grab those companies around an ETF structure. And then the third criteria is a time frame, which must be fairly long-term, ideally actually decades long or evergreen. And generally speaking, thematic investing is often used to broadly describe a forward-looking investment approach, but we believe it's important to distinguish between 2 distinct types of themes, cyclical and structural themes. Cyclical basically occur at somewhat regular short or medium-term intervals, typically based on the changes in business cycle. You can think about interest rates, how they have become so cyclical according to the business cycle. And this certainly can be mean reverting, like I said before. On the other hand, we have structural themes, and these occur as a one-off shifts that change an existing paradigm. These certainly tend to be longer term in nature and typically driven by powerful forces such as disruptive technologies or changing demographics and consumer behavior. And as you can see here, structural themes tend to follow an S-shaped adoption curve. These S-curves show slow initial adoption as innovators take a risk on a new technology. But then when the early majority begins to buy into a new technology, its adoption accelerates rapidly before eventually tapering off with the late majority and laggards adopting these new technologies, new emerging technologies. And while the S-shape curve can vary significantly, many important technologies over the last century or so have closely followed this S-shaped adoption pattern. And you can see here a kind of electricity, or more recently internet. How over the years these adoptions have happened faster over shorter periods of time, but all of them following this S-shaped curve. And where a technology lays on the S-curve really can provide useful insights on the characteristics of these technologies. Social media, for example, is one theme that has been adopted by many people around the world, but we still are seeing solid growth rates and new monetization opportunities by these companies. On the other extreme of the curve, we have themes like robotics and artificial intelligence with very low penetration rates. It's actually estimated that there are about 99 robots per each 10,000 manufacturing workers out there in the industrial segment. So that equals to about 1% robotic density. So very low penetration rates. That gives you an idea as an investor to where the growth opportunities may exist. And then, why do we think now is an important time for investors to consider incorporating thematic investment strategies in their portfolios? Well, we really believe that rapid advancements in technology and changing preferences are disrupting existing paradigms throughout the economy. Many sectors are really in the crosshairs of these disruptive themes. For example, robotics and artificial intelligence has the potential to dramatically changed the existing landscape for industrial manufacturing. As I say, a lot of robots are entering the industrial manufacturing space, and that could completely disrupt the industry as we know it. The emergence of lithium and battery technology could upend the existing energy complex based on the extraction and sale of fossil fuels. And we really can go on and on into traditional sectors of our economy being disrupted by many of these themes. And here we can see how, for example, communication services is being disrupted by social media. And more recently, we're seeing also how video games and esports are disrupting this sector with new media or communication ways for younger generations. So let's get to the meat of this presentation with starting with the first theme, Internet of Things. And basically, the Internet of Things, or IoT, describes a growing network of connected things that contain sensors, chips, processors, and the ability to interact with other devices on a network. And given that the cost of connecting a device to the internet is plummeting and that internet speeds are accelerating, the number of connected devices is expected to skyrocket over the next decade or so. And there are some estimates that the number of connected devices will reach 75 billion by 2025 from just about 20 billion last year. And IoT plays a critical role in many of the most powerful themes that we're seeing emerge today. This includes smart homes, smart cities, driverless cars, and even robotics. And if we look back at how 3G and 4G technologies developed, we can see that each new generation of networking technology has offered consumers new benefits. And 5G is expected to do the same, basically by using a high-frequency spectrum to offer network connectivity with a greater capacity, greater speed, and reduced latency relative to previous generations like 3G and 4G. And we believe our Internet of Things ETF really stands out to benefit from the rollout of 5G because 5G will prove to be a powerful force in accelerating connected devices in applications such as autonomous vehicles, smart homes, wearables, drones, and also smart factories. And when it comes to 5G, everyone likes to talk about the much faster speed that this technology will offer, but I actually like more the two other features that I mentioned, reduced latency and greater capacity. With reduced latency, we'll probably see greater adoption of robotic surgery, which happens remotely, or also advancements in autonomous vehicle technology. Latency basically is a delay in data communication over a network. So in both the scenarios that I just mentioned, robotic surgery and autonomous vehicles, latency is not acceptable whatsoever. So 5G is expected to tremendously benefit applications like these. The other feature is greater capacity, which will allow a network to handle more traffic. And this includes text messages, calls, social media activity, and many other kind of interactions over a smartphone. And if you think at the moment where you are in a concert or a big gathering event, text, photos, or video stream take forever or just can't get through. So this is a capacity issue, and 5G will enhance communication and social media experiences as well. If we drill down into the autonomous vehicle segment that we mentioned before, we can see how IoT, or Internet of Things, still plays a very important role. This is basically, I love this slide because this exemplifies the power that IoT will have in such emerging technologies such as autonomous vehicles. It is estimated that over the next 3 years, 2.3 million autonomous ready vehicles will hit the road. And all of these vehicles will need all kinds of sensors to transmit a wide range of data, such as GPS coordinates, engine health, also the surroundings with LiDAR and radar technology, and much more, right? So given these connectivity requirements, if we look at the dollar content of sensors required from a standard vehicle, we're talking about $400 worth of content, right? Electric vehicles pushes that figure up to about $2,000 worth of sensors. But the big jump in content really happens with autonomous vehicles, which, as you can imagine, require much more content of sensors and semiconductors in general. We're talking about approximately $15,000 in semiconductor content, which is basically over 37 times the current dollar content in a standard vehicle. So having this in mind, with about 2.3 million autonomous ready vehicles that I just mentioned that are expected to be on the roads over the next 3 years, the market size for all kind of semiconductors in the autonomous vehicle segment is expected to reach over $11 billion, combining both the commercial and consumer market sizes. And this is just one example. Again, this is the IoT is expected to penetrate other industries like healthcare with robotic surgery and all the sensors that these robots require. So we believe that the companies that could potentially benefit from the emergence of the Internet of Things consist of device manufacturers, network providers, and semiconductor manufacturers. And the Internet of Things is really looking at objects that used to be ordinary, meaning that they were not transmitting information, and now feeding these objects with sensors and connecting them to a network. Therefore, traditional computer or mobile phone companies are typically ignored because they're really the original connected devices. So here we're really looking at new devices. They're only now being connected to the internet. So let's move into video games and esports theme. Sorry, I had a problem here with a PowerPoint presentation. Bear with me for a second. I apologize for the technical issues. All right, let's get back to it. Again, apologize for the technical issues that we're experiencing. Okay, we're back. So again, going back, and I apologize, going back to the presentation here, in starting with the next theme, video games and esports. We really see this theme is standing out in 2020 because it's a consumer-driven theme that should benefit from strong consumer tailwinds. You can think about good employment rates, low interest rates, as well as the rise of the millennial and Gen Z generations which enjoy digital experiences. What is so important to identify is that the video games and esports market is a very large one, and we're talking about $150 billion market that, just for context, is larger than the box office and music industry together, and it's growing in the high single-digit range. And the way media is being consumed today, especially from these younger generations like millennials and Gen Zers, clearly support the continuation of growth as dollars transition to these new media outlets. And 2020 has something more in store for the video games industry. 2020 is expected to be the year of the new super cycle in the console market. So every 5 to 7 years, console manufacturers bring to market the new generations of consoles. So this year, both Microsoft and Sony are expected to release the new Xbox and PlayStation consoles during the holiday season. This is going to represent the first major hardware upgrade since 2013. So these new consoles are expected to feature 8K TV support, ray tracing technology, solid-state drive storage, basically enhancements that will bring unprecedented realism to games and also faster load times. So you may be asking, what does this mean for the video games industry? Well, historically, the release of the new console generates positive spillover effects for game developers. And after all, what's a cutting edge console without a new game that can basically take advantage of all these features? The last console upgrade cycle translated in strong stock returns for game developers, as you can see in this chart. During that period, the 2013 console upgrade cycle, which included the Xbox One and PS4 rollouts, on average, all these leading game publishers like Activision Blizzard or Take-Two Interactive, Ubisoft, Electronic Arts, all of them outperformed the broad market in tech and the tech sector as well. This time around, a big difference is that the hardware manufacturers are not only focusing on the new consoles, they're also thinking about the launches of their cloud gaming platforms. So PlayStation Now and Microsoft xCloud are two of these platforms, but also tech giants like Google, which recently introduced their Stadia cloud gaming platform. All these companies are really looking for new avenues of growth in the game space. And cloud gaming means that the games are run from a remote server and stream across TVs, laptops, desktops, tablets, and also smartphones. And gamers can basically play the same game from device to device on the go and picking up exactly where they left off. So just as Netflix disrupted the distribution model for movies and TV shows, cloud gaming could have a similar impact on the video game industry. But the new super cycle is just one more tailwind to the many others that are taking place in the industry. Esports and streaming are two of the newest growth avenues for the video game industries that didn't exist until very recently. Esports basically has professionalized the industry with teams participating for dollar awards in tournaments and getting sponsorships, while streaming really has been the new avenue to monetize gaming. And Ninja probably is the best example when it comes to streaming. He may not be the best player of Fortnite. Hopefully, he's not listening to this presentation, but he's a great content creator. So gamers like Ninja usually get a cut from the subscription paid by the viewers on platforms like Twitch or Mixer here in the United States, but also platforms like Huya or Douyu in China. And the audience is really huge. Last year, there were about 440 million total viewers around the world. And in many cases, a much larger number than people watching traditional sport. This is true for younger generations, which are actually watching more other people playing video game than actually watching traditional sports. So now let's move to the last theme of the day, lithium and battery technology. Super interesting theme. And starting at a very high level, lithium is considered the world's lightest metal and has been dubbed as white petroleum due to its common usage in state-of-the-art batteries. And many are familiar with lithium's use in batteries, but the majority of lithium demand, actually over 50%, has come from non-battery sources like greases, ceramics, glass, and medicine, a bunch of industrial applications. Of the amount of lithium used for batteries, the majority is for personal electronics like smartphones, tablets, and laptops. electric vehicles are just starting to represent a material portion of the industry. And as we can see from the chart on the right, the auto industry has the potential to massively disrupt the lithium demand due to the expected increase in adoption of electric vehicles. Actually, lithium demand is expected to increase by about 6 times by 2030 to 1.8 million metric tons of lithium carbonate. So that's from about 300,000 metric tons last year alone. And then in 2018, the top 5 lithium producers in the world control about 2/3 of lithium supply. Yet we're really seeing many smaller new entrants in the space that are seeking to capture the potential opportunity. So lithium miners, both majors and juniors, are expected to benefit from the rapid adoption of EVs and the need from these OEMs to get access to lithium-ion batteries. So on the demand side of the equation, we just talk on kind of the supply side from these lithium miners. You may be asking, why now electric vehicles, right? Why do electric cars seem to be popping up all over the news these days? So there are 2 major things that have changed. On the cost side, battery costs have plummeted rapidly. Battery costs have declined about 90% over the last decade, and this has obviously made electric vehicles much more affordable than they were in the past, making them possible in mass market applications. In fact, EVs are coming close to reaching the estimated price parity point with internal combustion engine car. We're estimating that by 2023, 2024, an electric vehicle will reach that point of parity with an internal combustion engine car. The second thing that has changed is government policy, as you can see on the right side of the screen. Some governments have been supporting EVs for years through tax incentives, but it has been taken to a whole new level by countries setting an end date for the sale of internal combustion engine vehicles. Some cities are banning vehicles that don't have zero or low emissions due to air pollution. Also, new gas mileage regulations are expected to drive up the cost of internal combustion engine vehicles, which can actually make the cost parity point with EVs to occur sooner than previously expected. So bringing this back to lithium, you may ask how much lithium demand could be spurred by the adoption of electric vehicles. And as you could expect, electric vehicles use a lot more lithium than other electronics. In fact, they use approximately 10,000 times more lithium than a smartphone. So if the EV market reaches high levels of penetration relative to the current total vehicle market, we could clearly see how lithium demand could continue to increase over the next few years. And the real test as to whether electric vehicles will go mainstream is whether the auto industry is willing to broadly adopt this technology. And here's just a few news and announcements from automakers that have committed to electrifying major portions of their fleets over the next few years. And these OEMs are really accelerating their initial timeframes, announcing more electric vehicle models in a shorter period of time than initially expected. So all in all, the strong EV demand is expected to have a positive spillover effect on the lithium supply chain, including upstream lithium miners and also these downstream battery manufacturers. So those were the 3 themes of the day: Internet of Things, video games and esports, and lithium and battery technology. But really, when you have so many attractive opportunities that are converging and reinforcing one another, this is really where the opportunities are found. We talked about lithium and battery tech, and this is going to be very important for tomorrow's infrastructure, for example, which has to be completely modernized to adapt to new forms of transformation. We'll also talk about the Internet of Things and how this theme really sits at the intersection of so many powerful themes like cloud computing or cybersecurity, as more data needs to be secured. Robotics and artificial intelligence, as well as an IoT, plays a critical role in powering collaborative robots, for example. So the fact that these themes are converging is really powerful for the companies in the space, but also the economy as a whole. Where does Thematic fit in a portfolio? We think it fits best for long-time horizon, growth-seeking investors. Yet the challenge is often in how to fit in a portfolio when it transcends typical geographic and sector classifications. We often find that investors feel the most comfortable carving out a thematic or opportunistic bucket in their portfolios where they ignore geographic and sectors. This segment often comes out of the equity portion of their portfolio, as you can see here on this slide. It is important to think about both the risk and return characteristics of thematic investing, and when creating a portfolio of themes, to try to capture growth while mitigating risk associated with any one theme. So trying to mitigate idiosyncratic risks that any one theme may have. So one potential way to approach this issue could be to own a basket of themes and to weight those themes by realized or forward revenue growth expectations. So this really helps diversify exposure to any one theme while still tilting exposure towards higher growth potential themes. And Global X has a variety of growth-oriented thematic ETFs in the technology, people, and infrastructure suites. Today, we talked about only 3 of these themes, but really we have much more than that, as you can see here, including bots, for example, our robotics and artificial intelligence ETF, and many others like social media, fintech, autonomous and electric vehicles as well. So again, thank you so much for your time today. You can really find more research on our website or following us on Twitter. We put out a lot of research and insights in the thematic space, but also for our income ETF suites or for our international ETF suites, single country exposure. And you can really reach out to us if you have any questions. Here you have some information. With that, I'm open to answer any questions you may have. I'll show some important disclosures while we wait for the questions to come in as well.
Thanks, Pedro, for your presentation today. What exciting hot topics that you got to cover, and you did a lot in a short period of time there. We love the way Global X breaks up the market. They cut the technology sector in different ways that others aren't really thinking about it. So it's always great to have your insights here with us. Let's definitely take some questions from the audience. We've got Ashley Winkler. How much and how long would you suggest to invest in the esports industry in order to see a gain?
Yeah, this is certainly a theme that is disrupting the communication services industry as we know it, right? We cannot advise in terms of how big a portion of your portfolio that single theme can be, but it's really fascinating the growth opportunities that exist today that didn't exist in the past. So we talk a little bit about cloud gaming and how that's going to disrupt the way gamers play from device to device. We talked about esports a little bit and also about streaming, but really it's a full transformation what we're seeing in the industry. In the past, game developers and game publishers used to have to rely on manufacturing and supply chains to produce that physical video game and then rely on a third party to finally deliver the game. That was the end of the transaction for game developers and game publishers. Today, with the introduction of cloud gaming and digital delivery of the game, we're really seeing how these companies are generating recurrent revenue that didn't exist before. They're also introducing the games for free or free-to-play format in an attempt to monetize this gaming base on a recurring basis. So this is allowing companies to increase their margins, to have better fundamentals than in the past.
That's really great. We've got some more questions coming your way, and just a reminder, if you do have questions, it's still not too late. We'll be scrolling through the chat, and we'll definitely continue to take questions for at least 10 more minutes or so. So Liz Blair asks, what percentage of a person's portfolio would you recommend putting towards thematic investing versus others? What kind of risk is involved in that?
Yeah, no, fascinating question. And I talk a little bit about that, right? Usually, an investor tends to have a bond and an equities portfolio. It really depends on the time horizon of that investor, the age, if it's closer to retirement, or if it's just in their early career or career development stages. So it really depends to that. But usually, and this is kind of a very general answer, we recommend carving out a bucket, an opportunistic or growth bucket out of your equity portion of the portfolio, usually 10%. If you're closer to retirement, probably less than 10%. But really, that's the bucket that serves to capture future growth opportunities. I think the previous speaker, Kristen, she was showing 3 different buckets that an investor should have in their retirement portfolio. And that third bucket that she talked about, it's really about kind of thematic investing and the forward-looking opportunities that could also mitigate some of the risks that current companies or current sectors in our economy may face in the future, right?
That's a good point, Pedro. I know it's a concern right now, given all the volatility we've seen, that maybe some of these types of companies could get hit a little bit more hard than other companies. But to your point, Christine made that point that you can have 3 buckets, and also you don't want to miss out on these type of stocks or ETFs when the market does bottom and they lead the way higher. So it's a good point. Teresa in PA asks, which ETFs cover esports?
Yeah, well, I can talk about other ETF issuers, but we have our video games and esports ETF. The ticker is HERO, HERO, and that provides you exposure to the overall supply chain within the video games and esports industry, from game developers and game publishers to the hardware manufacturers and even the GPU processor manufacturers as well, all the way down to streaming platforms and esports teams as well. So a holistic view, a very diversified approach to get exposure to video games and esports.
All right. Your ETFs are always interesting to look at. So we got another one. Jensen, what are some other themes you're most bullish or positive about?
Yeah, no, great. For time's sake, we could only talk about 3 themes, but there are so many things happening in our economy today. One that I particularly like a lot is the cloud computing theme. We also have an ETF on cloud computing. And these are really companies that sometimes are consumer facing. You can think about software as a service platforms that are really powering many companies today. But the companies that provide these software as a service solutions have fantastic business models with a strong generation of recurring revenue, great customer retention rates, the clients that use these applications are generating huge return on investments, or ROI, and this is why it's such a sticky business model that these companies have. And it's also very much insulated to many disruption that we may see in the manufacturing context. Last year with the trade war, a lot of the technology side of things that related to hardware was impacted by this kind of trade conflict. Now with the current issue of the coronavirus, we're seeing also how supply chains are being impacted. But the software side of things, the software side of technology, is a bit more insulated to all these negative disruptions that we're seeing in our economy. So that cloud computing theme is and the cloud computing ETF is really a fascinating sector with a lot of opportunities, and one that I'm quite bullish about.
Thank you, Pedro. That's some really great insights there. You got to cover so much in your presentation. Where should our viewers go to get more information from you? I know you mentioned it earlier, but just one more time.
Yeah, no, absolutely. So globalxetfs.com/research. You can go there. We have an open architecture for research where pretty much everyone can get to see what are our insights, where are we looking for opportunities in the thematic space, but also other investment strategies. And there are some opportunities there to get in touch with us. You can also follow us on Twitter. We continue to put out a lot of information and insights via Twitter as well.
All right, wonderful. Thank you again, Pedro, for your time today.